Welcome, welcome, welcome. What chapter are we doing? We are doing chapter number 1 from AFM. That is your financial policy and corporate strategy. Sir, how many marks does this chapter come from? This chapter, this chapter comes from average of 4 marks. Okay, very easy chapter, nothing to worry about. We will start with this chapter. Okay, so now what you have to understand is this chapter has only basically one, or if you say two formulas, okay, nothing else, and those two formulas are also very logical. Okay, so we'll start. So basically this chapter first talks about sustainable growth, and second it talks about external funding requirement. Both of these topics are opposite to each other. Sir, what do you mean when you say these are opposite to each other? When we say these are opposite, sustainable growth, the concept sustainable growth rate means the maximum rate of growth in sales that can be achieved given the firm's profitability, asset utilization, and desired dividend payout. So they are asking, ki, sir, what is the maximum that I can grow without borrowing money? I do not want to borrow money. How can I grow sustainably? What is the max that I can achieve sustainable growth without borrowing any money? Okay, so the formula is very simple. SGR, that is your sustainable growth rate, is equal to your ROE. ROE stands for return on equity. I hope everybody is clear with this. Okay, so ROE into 1 minus dividend payout ratio, or you say 1 minus dividend payment ratio. What do you mean by 1 minus dividend payment ratio? 1 minus dividend payment ratio is nothing but your retention ratio. Tell me, is that right or not? If you are paying dividend of 30%, that means you are retaining 70%. And only what you are retaining will have returns. Is that right or not? So therefore, we are multiplying whatever you are retaining with your return on equity. That is usually what return do I get on equity. You multiply that by whatever percentage is left in your business. That is your retention ratio. So this formula can also be written as ROE into your retention ratio. Perfect. Whoever have these notes, you can write this alternate formula down as well. And we will move on to the next part. Okay. So the next part talks about external funding requirements. Sir, what do you mean by external funding requirement? When we say external funding requirement, we say that what we mean is how much does the company need to borrow? How much does the company need to raise through equity to achieve a certain level of growth? Okay, so first we'll see the formula and then we'll see as to how to use this. Okay, so EFR stands for external funding requirement. This formula I will break it down into three parts. Sir, why three parts? I will show you. So your first part is your CA upon sales upon into change in sales. Then your second part is your payables and liabilities into change in sales. And your third part is your MS1 into 1 minus D. Okay, now we'll understand what do these exactly mean. Okay, if you see in the first part, what are we doing? We are finding ratio. We are finding total assets upon sales into change in sales. Sir, why are we doing this? We are finding that if my sales were to increase, if I want to increase my sales by 20%, how much more assets will I require? How much more payables and liabilities will increase, and how much more profit will I receive? Okay, so these are the three parts of the formula. So if you see the first part, in the first part, what are you doing? You are doing total assets upon sales. You have found the ratio. These are your current sales. So you have found that how much assets are required to maintain this level of sales, and then you multiply it by change in sales. If I say my sales are increasing by 20%, so my assets will also have to increase in the same proportion. Tell me, correct or not? Therefore, first we calculate the ratio of total assets upon sales, and then we multiply it by change in sales. So by this first part, we will get how much additional assets do we require. Okay. Now the second part is your payables and liabilities. Sir, if I was to sell more, if I was to increase my sales, will my creditors not increase? Correct? My creditors will also increase. So therefore, since my creditors will increase, does my requirement for cash increase or decrease? My requirement for cash will decrease because creditors have to pay later. Correct? So therefore, there is a minus sign here. I know most of you said positive. that they will increase. When my creditors increase, my cash flow increases, right? Because I have to pay them later. So therefore, the next ratio that we are finding is our payables and liabilities. So we are finding payables and liability. This is your second portion. So first we found exact same thing. We are finding the ratio that as per our current sales, what are our payables. So we found this ratio and we are multiplying it by change in sales. So we will understand what will be our increase in liabilities or increase in payables. Great. And next part is we are subtracting. Sir, we are subtracting what? Okay, let's understand what MS1 into 1 minus D is. Okay. Perfect. So M is your profit multiplier. M is your profit multiplier or your net profit after tax. This is your percentage of profit. So what are we multiplying this? We are multiplying this with our revised sales. That is, if our sales have increased by 20%, that means if originally it was 100 and now it is 120. So we are multiplying this by 120. Why are we multiplying profit percentage with 120? This is basically what will be your profit at the increased level of sales. Correct? Is this not right? This is nothing but profit at increased level of sale. But, sir, you are also giving something as dividend, right? So you don't have that cash with you. What we are trying to find, we are trying to find how much funding will I require. I will also subtract the funding that I'm able to give myself, that is the, by way of profits. Correct. So therefore, we will have to subtract whatever dividend we have paid out. Understood. So therefore, when we are multiplying by 1 minus D, of course, we are again doing the same thing. That is, we are multiplying it by whatever is retained in the business. Okay. Formula is clear. Now let's understand the question. Okay. This chapter only has this question. So let's see. So they've given us share capital. Okay. All the figures are in lakhs. We will ignore lakhs. Okay. So share capital, they've given us 3,000. Reserves 2,000, long-term loan 4,000, short-term loan 3,000, payables and provisions, and then they've given total. So if you see your payables and provisions, this is part of the formula, second part, correct? So our total is 14,000. Same way on the asset side, they've given us fixed asset, inventory, receivables, cash, and we've given a total at 14,000. Okay, now they've also given us some additional information that your current sales, this sales what they are mentioning, this is your current sales, or you can also call as S0. So your current sales is 6,000 lakh, which is expected to grow by 20%. Sir, what does this mean? If they are saying that it is expected to grow by 20%, what they are telling me is that my S1 is equal to 6,000 into 1.2, or basically adding 20%, correct? So when you multiply, you will get 7,200. So 7,200 is your retired sales. Next is your profit margin. Profit margin, they've given you 4%. What is this 4%? This is your MS1. So they've given you M. So this 4% that they've given you is M in the formula. Okay. Payout ratio is 50%. That means 50% I'm giving as dividend, 50% I'm retaining. So this is your the next desirable ratio. So they're saying that after you raise the money, there are certain ratios that you have to match. So first is sales is to short-term loan. Sales to short-term loan and payable and provision is 4:3. So here you have short-term loan and you have payables and provision. So that ratio should be 4:3. Then you have fixed assets to long-term loan 1.5. You have debt equity ratio should be less than or equal to, that is at max 1.5. You have to determine the amount of external funding requirement. What is the amount of EFR and the amount to be raised from short-term loan, long-term loan, and equity. Of course, when you are doing external funding requirement, of course, you will have to raise this money from somewhere. So first they've asked you what is your total EFR requirement and how do you bifurcate that EFR, that how much I will take from short-term loan, how much I will take from long-term loan, and how much I will take from equity. Okay, so let's start the question. So all of this that was in colored was part of your question. Now we are coming to our answer. Anything in black will be your part of answer. Great. So they've given us expected sales. They've given us expected sales is equal to 6,000 plus 20%. We calculated the same thing here, 7,200. Okay. Then what have they done? So we are going to solve this question without using formula. We are going to use only logic. And with logic, I am sure you do not need to learn the formula. I don't want you to learn. I want you to understand. Okay, so our expected sales, we have our new sales. Next is your profit. This is your third part of the formula. So how much would your profit be? If you remember the formula, it was MS1. Over here, it was all original sales, that is S0. Over here, we are using S1, that is your revised sales. Great. So this is one thing that you should all remember, that in the third part of the formula, it should be your revised sales. So you multiply 7,200 into 4%, you get 288. So 288 is your amount of profit. But tell me, boss, have you retained all of this in the business? Answer is no. So what will you do is, how much is the retained? You have retained only 50%, because 50% you paid out. So how much have you retained? You have retained 1 minus 50%. So 50% into 288 and you get 144. Okay, I hope this is clear. So you got this 144 is your third part of the formula. Great, beautiful. Next, we will see what will be the increase in assets. If our sales are expected to rise by 20%, won't my assets also rise by 20%? Correct. So what was my total of assets? My total of assets is 14,000. So our increase in assets will be 14,000 into 20%, that is 2,800. Now this 2,800 is basically your first part of the formula. Correct. This 2,800 is how much assets have to be increased. So this 2,800 is your first part of the formula. This 144 we've already calculated, third part of the formula. Great. Next is increase in your payables and provisions. Your payables and provisions will also increase. This is your second part of the formula. So your payables and provisions will increase by 2,000 into 20%. That is your 400. Got it? So what would be your net increase? Net increase would be the amount that my assets increase subtracted by the amount that my provisions or my payables are increasing, and then you will subtract how much profit you are earning through this business. So therefore, net increase would be 2,800. 2,800 is your assets increase. Then you 400, that is your increase in payables and provisions. However, this 144, our 144 will be financed through retained earnings. So therefore, what is your external funding requirement? How much money do you need from outside? That would be 2,400. This 2,400 is basically 2,800 minus 400. So that would be 2,400 minus 144. That is your 2256. So 2256 is actually your external funding requirement. This is your part one of the question. Okay, I hope everything was clear. Our assets increased, our payables and provisions increased, and we also earned some profit. So increase in assets will be added, increase in payables provisions will be subtracted, and whatever profit you are earning multiplied by whatever you are retaining in the business will be subtracted, because you are financing that from within your business. Got it? So your 2256 is your EFR. Okay. Now we will understand the ratio that they were telling us. What was the first ratio that they told us? They told us that, boss, your first ratio, that is sales to short-term loan. Sales to short-term loan should be 4 is to 3. Sir, this is after raising money. Correct. So 4 is to 3 is after raising money. This should be the ratio. Okay. So we've done sales upon short-term loan plus payables and provisions is equal to 4 by 3. I'll just change the pen color so that it's easier. Yes. So sales upon short-term loan and payables provision is 4 by 3. So now our updated sales figure is what? Do not write 6,000. Our updated sales figure is 7,200, because these ratios we have to manage after we increase our sales. Correct. So therefore we will write 6,000 into 1.2, that is nothing but 7,200. And we will let this be a variable. Short-term loan and payable provision, we will let that be a variable, and we multiply equated by 4 by 3. So therefore, when you solve this, you get short-term loan and payables and provision should be a total of 5,400. This is what it should be. This 5,400, when we are saying, this is what it should be. Now let's calculate what it is actually. our short-term loan is 3,000 and our payables and provisions is 2,000. Oh, this is only 5,000. No, your payables and provisions is not 2,000. Your payables and provisions is 2,000 into 1.2, which is equal to 2,400. You will get 2,400 plus your short-term loan is of 3,000. So therefore, our current status is also 5,400 and our should be is also 5,400. So therefore, no amount to be raised from short-term fund. Tell me, is this clear or not? First, we calculated this 5,400 as to what it should be. Then we calculated what we will be at. So therefore, we will already be at 5,400. So therefore, in this case, nothing has to be raised from short-term funds. Clear? Okay. Now let's understand the next part. The next ratio was fixed assets to long-term loans should be equal to 1.5. Great. So we've done fixed assets. What we have done is fixed assets upon long-term loan is equal to 1.5. What is your fixed assets? Your fixed assets is 6,000 over here. So we will do 6,000 into 1.2 because this is after growth. Okay, so we 6,000 into 1.2 upon long-term loan is equal to 1.5. So your long-term loan, so you will get your long-term loan should be 4,800. Okay, this is your should be figure. Now let's calculate what it would actually be. What is your fixed assets? Your long-term loan. Currently, your long-term loan currently is 4,000, sir. Will we multiply this by 1.2? No. This does not, growth does not impact your loan. Your loan does not increase by the same amount. Your payables provision will increase, but your loan will not increase. So therefore, you will compare this only with 4,000 and not multiplying it by 1.2. Remember, do not multiply it. Okay, so you do not multiply, so you compare that your current is 4,000 and what you require is 4,800. So you will basically need 800. You need 800, which is to be raised through long-term funds. So first part we've understood that your short-term fund is zero requirement. Your long-term fund we require to raise 800. So where will the balance come from? Because total, we remember we had to raise 2256. Tell me, is that right or not? We had to raise total 2256, but only 800 of it is coming from long-term funds. So sir, where do we raise the balance from? Balance you will be raising from equity. So everybody take your calculator, do 2256 minus 800. How much do you get? Everybody gets 1456. So that means that 1456 will have to be raised through equity. So therefore, this is the same figure that you are getting here. So 1456 will be raised via equity. Got it? So our brief summary would be 0 from short-term loan, 800 from long-term loan, and 1456 from equity. If you see, we solved this entire question without using the formula. If you want, IC has also solved this using the formula, and you can look at the ICA model if you want to solve using the formula. But I would strongly suggest to understand the logic of what we are doing and figure out instead of just learning the formula. I hope this was clear. If you have any doubts, put it in the comment section, like the video, and I will see you in the next chapter. Bye bye.